Well, Deputy Finance Minister David Masondo says South Africa got this positive outlook from S&P due to the government debt to GDP stabilizing and higher revenue than its expenditure. Masondo was speaking at the ongoing NEC meeting at the Ekurhuleni Council chamber. All right, let's further expand this discussion by welcoming Dr Azar Jammine, who is the Director as well as Chief Economist at Econometrix. Dr Jammine, it's such a pleasure. So welcome to SA Today. So the first increment of our rating as a country in almost 20 years is quite welcome news. What does this effectively mean, though, for South Africa?
In the short term, the effect has already been seen in the form of an appreciation in the value of the rand. In fact, even straight after the announcement, the rand rallied about 0.5%. But more generally, in the last few weeks and months, the currency has gained ground by around 10% or so against a basket of currencies. Part of that is due to the fact that we've come off the grey list of the Financial Asset Task Force, but much of it also has arisen out of the improvement in our fiscal situation. In turn, some of that has come from the fact that our tax receipts from profits of mining companies have been enhanced by the surge in many metal prices, gold and platinum being the most important amongst these. But more generally, also the government has been much more circumspect in terms of its expenditure, and as a result has been able to curtail expenditure to levels below the taxes that it collects, and this is starting to enable it to put an end to the vicious cycle of rising borrowings and higher public debt. So what it means for South Africans is that inflation will turn out to be lower than expected, and this in turn can provide the scope for further cuts in interest rates in the next few years, which in turn ought to be supportive of economic growth.
Mm-hmm. And Doctor, I understand, economists are still there cautioning, of course, for those reforms to continue. But in reality, Doctor, are we on track for this GDP recovery rate as it was expected to only average at 1.5% over the 2026 to 2028 timeframe? Are these reforms then pertaining to electricity and other sectors stable enough to maintain this projected growth over the next 3 years, you think?
Well, firstly, you need to ask yourself what the growth rate would have looked like had we not introduced these reforms for electricity and logistics. It would have been closer to zero or even negative. So, yes, thank heavens for those reforms. Secondly, though, you've got to recognize that the full benefits of these reforms, especially in the logistics area, such as improving our ports and rail networks, it's a long-term project and is going to take several years to yield benefits. The same with electricity supply, especially if you've got renewable energy going, you won't reap the full benefits of that until you provide enough grid capacity to carry all that new electricity. So it's a timing issue as well. One should not be too impatient with expecting miracles from some of these reforms. But yes, you're quite right. There's a lot more that needs to be done over and above worrying about electricity and logistics and rail and water and municipal competence. There are issues such as putting an end to criminal syndicates who are scuppering attempts at infrastructural investment. There's a huge amount that needs to be done to improve educational outcomes in the country, to render to provide skills and to render those coming out of school and university far more able to gain jobs. A huge amount has to be still done to address the lack of vibrance in small business activity in South Africa due to over-regulation by the government. And then you've got the whole issue of spatial inequality, where people are working so far from where their jobs are, which acts as another massive cost on people. There are many more such structural impediments to economic growth that need to be addressed before we really start seeing growth rates in excess of 3% per annum. So, yes, let's not get carried away with this, but at least it marks a turning point in that one of the big fault lines of the country is, namely the deterioration in the fiscal situation, is really being addressed by the government of national unity. And this credit rating upgrade reflects an acknowledgement of the fact that the GNU is finally trying to tackle this problem of government overspending and leading to more and more debt.
A very quick one, Doctor. I mean, to our credit as well, we are seeing stronger than anticipated fiscal performance that has, in some aspects, actually outperformed some budgeted targets. And the recently tabled mini budget considered much better than that whole VAT impasse. But the public is asking, I know you just mentioned we shouldn't expect miracles at this stage, is asking when exactly will they start seeing the benefits? As, the overall cost of living is just way too high currently. Electricity is also said to increase next year. A very quick one, Doc.
You've got to realize that that is one of the fundamental reasons why the Reserve Bank has pressured government to reduce the inflation target down to 3%. Little by little, consumers are seeing the benefits. We would not have had a surge in retail sales and in car sales this year if people were still finding life unaffordable. They are benefiting already because they're getting wage increases of 5 to 6% and inflation is down to 3%. So that a nice gap has already started filtering through, and this is likely to continue given the commitment to a lower inflation target and a higher credit rating, which will enable the rand to strengthen further and bring down inflation even more, and finally enable interest rates to start coming down. Maybe not immediately, but certainly through the course of the next 2 years.
You're very optimistic. Thank you so much for your optimism, Doctor. We're going to leave it there. Thank you so much for that meaningful engagement with Dr Azar Jammine there, who's the Chief Economist at Econometrix on South Africa being upgraded by Standard & Poor's.